And good afternoon. Welcome into Market Talk for this Tuesday, February 15th. Great to have you with us. Thanks for making us part of your day. I'm your host, Jesse Allen. Again, thanks for joining us. Find us online. MarketTalkAg.com is our home on the web. MarketTalkAg.com is where you could find us. All of our social media links are there. All of our streaming sources, all the ways you can listen to the show, watch via YouTube, everything. You can find it all, including news of agriculture and more at MarketTalkAg.com. Well, we had we'll call it a down day in the grains with an up day in livestock. So we were split between grains and livestock today. A lot of pressure in these grain markets, though, tied to the geopolitical worries in the Black Sea region and much more. Here to talk about all of it on this Tuesday, let's bring in our good friend Brian Splitt with agmarket.net joining us this afternoon. Brian, good afternoon to you, sir. And another day trading headlines, it appears, in the grain markets, at least, as a lot of pressure throughout core beans and wheat today.
There was, yeah. I mean, we're kind of doing the hokey pokey right now with this Russia-Ukraine narrative. Put your right foot in, take your right foot out. We're doing it, every session. Late Friday, the word was it was imminent and it was going to happen. And then coming out of the weekend, it seemed like, all right, and it's not. And then yesterday afternoon, the Ukrainian president made a comment that Wednesday was the invasion day, and then afterwards it was reported he was being sarcastic. And now this morning, reports of Russian troops heading back towards base. So there's an awful lot of headlines that are moving the market substantially in short periods of time. I think you'll see that continue. And it's really hard to differentiate the risk premiums in the market right now, because I think you've got a certain amount of risk premium that's there because of the geopolitical tensions in the Black Sea region. I think you've got an awful lot of premium that's in the market just because of inflation and the CPI readings that we're getting, and the PPI readings here this morning. So inflation is still hot, but and then you've got premium in the market because of South America. And so when you kind of take a step back and look and see what we've done, we had the report last week. The day after, we had the CONAB number on beans that dropped it to 125. That was a big cut. You had the CPI number, which was very inflationary, and yet the market's gone down after those numbers. So, have commodities seen an awful lot of buying near these highs in front of this data, and then added even more buying because of the geopolitical tension. And it seems like there's maybe a fair amount of length in the market right now that is starting to feel a little bit of pressure and is underwater.
Well, and you mentioned that risk premium, and there's so many different factors there that you alluded to, and one has to wonder, and you kind of answered the question I was going to ask next is, how much could we potentially take out if Russia continues to de-escalate here? How much could we take out, as we move forward and see, some of these tensions go away? We start to get the combines rolling in South America, maybe see a little bit better yield. I mean, one has to wonder how much risk premium we could take out here or put back in if things change, because it seems like all these different stories, things are changing just on a dime right now, Brian.
Well, that's right. You look at corn, for example, and we came down and hit the 10-day moving average today. And so the 10-day has been kind of a pivot point. When the funds want to own it, they support it at the 10-day. So for hogs, for example, we saw hogs yesterday in April go down to 101 and hit the 10-day moving average just to trade above 105 today on the bounce off the 10-day. So, do we get something like that tomorrow where, if you just fade the close pretty much every session, you're going to be right the following day? That's almost the way it seems right now. But we do have a gap below the market. We had gapped higher after the weekend coming out February 3rd. So that was last weekend. That gap in the May contracts down in that 623 area. Is that a potential target if we get some additional weakness? Sure. I think you've got the longer term uptrend from your January lows after the January crop report is going to be in that vicinity as well. You look at soybeans. I mean, we just tacked on so much value in such a short period of time. I think you're going to have a lot of people kind of breaking out their Fibonacci retracement levels and saying, all right, well, we made this low and we made this high, and this will be 50% and this will be 62%. Where are those numbers? And maybe they match up with some moving averages or a gap or a trend line, and that may reinforce, the potential to go back and recheck that area.
Well, Brian, as well, you mentioned soybeans. I know the NOPA crush numbers came out today, 182.216 million bushels in January. That's down from 186.4 December. Average trade get estimate coming in was 186.6. Do you take any stock into those NOPA numbers? Is that something that could maybe help out this soybean market overall in the long run?
Well, everybody's really looking for crush to stay very active. We've had fantastic crush margins. The USDA has acknowledged that. So I think the concern would be if crush starts to miss like it did today. And, I don't know if this is early or if it's going to even escalate any further, but, we are seeing bird flu in some of the headlines. That has been something that in previous years, and it may not be something where you say, oh, we're going to miss this much demand. Sometimes it's just a narrative shift. Something like that can change sentiment. And again, based on the amount of length that's in a lot of these markets, if you start, finding little cracks in the armor, a little something here on bird flu, a little something there on, as you'd mentioned, maybe we get a week, or I should say a month down the road, and the Brazilian yield numbers are not as bad as what we priced in. What happens if we get the interest rates to take a bit of a hike here? What does that do to manage money, thought process on positions? So there's just a lot of different headwinds and tailwinds right now that need to be sorted out.
So if I'm a producer with all these headwinds and tailwinds, if I'm looking at my marketing plan now after the February WASD, I'm really examining things here before we start to ramp up spring planting here in the U.S. Any new recommendations, or are we kind of keeping with the same themes of really just looking at your bottom line and what works for your operation?
And that's, I think, generally going to be the best theme to operate on, is not worrying about what you think of price, but think about what, levels and what your income is at these price levels. And if you still want to be bullish, can you go ahead and sell cash and buy a call to keep yourself in the game? I mean, you're only out of the market if you want to be after you make a cash sale. There's other ways to keep yourself involved. Whether or not you want to take marginable risk on that reownership, or if you just want to have a known risk up front, those are all conversations that you need to have with yourself when you're re-implementing some kind of a strategy. But yeah, I think if you want to hold on to your physical, and if you're still long-term friendly, I just have something that's inside of me telling that these markets may just reset during the month of March, and we could have a lot of commodity weakness during March just to have the fund manager come right back in and reload going into summertime, especially in the ag markets. So I do think that maintaining some kind of puts under physical, if that's the route that you're going to go, is probably something that you should consider. Or at least have a point where you say, what, I've defined my income mentally, and I don't want to have it go below this amount. So maybe, kind of keep a mental stop below your cash position and say, hey, if we start getting below this level and my income is now here, and that's the lowest I'm willing to accept, then you have to take action if you get to that level.
Brian, energy market seems pretty tied to the Russia-Ukraine worries as well. I know crude oil back down around $92 a barrel here as we're talking this afternoon. Any thoughts with the energy markets as well, and just how they're looking and tying into our ag commodities right now?
Well, there seems to be maybe a resurgence of the mentality from 2008, for example, when commodities were seen more of as an asset class rather than being seen for their individual fundamentals. And we do have to admit, a lot of these commodities do have good fundamentals because of how things have worked out over the last 2 years, between seeing some extremely low prices because of demand destruction from COVID, then seeing demand come back online faster than production can come online. And I think that's the general gist of the energy trade right now. But, that thought process broke the market a little bit in 2008. And then when we had some outside market dynamics that kind of forced the position manager to exit, there was a lot of exiting being done in numerous markets all at once, and there was not much of a bid. And so I don't want to pretend like that can't happen again. So, here we are all over again, where commodities are outperforming equities. There's a lot of money in a lot of commodity markets. Could there be some kind of outside market force that causes the fund manager to say, you know what, I've made a lot of money on these long positions. Maybe I'm going to hit the exit here for a little bit and look to reown it again down the road. And I feel like I'm just waiting for that shoe to drop. I don't know what shoe it is or who's wearing that shoe, but I feel like it, that could be coming around the corner.
Well, Brian Splitt with agmarket.net, our guest today here on Market Talk. Brian, let's switch over to livestock, and cattle and hogs had a good, strong day on Tuesday. Some of that, I'm sure, tied to the lower grain prices, those lower feed prices. But, overall, we've been seeing strong moves, especially in this hog market. Let's start there. April taking lead month now. It's at a, uh, you know, April to cash, there's a big gap there. What do you think about this hog market? Do you think we're going to see a bit of a pullback, or this hog market just doesn't seem like it wants to slow down right now?
No, earlier in the segment here, we talked about the 10-day moving average in April hogs. We hit at that 101 level and had a very good bounce. So, we'll see if corn can do the same thing. But you had mentioned the strong premium to the cash market in these April hogs. And I do think that we're going to have those markets come together and meet. And my thought is if we end up getting below that low that we had here a couple days ago at 101, or I should say that was just yesterday. I think if you see the market trade below 101, we're going to start searching for some of the areas below the market. We've got some gaps to fill. You just look at a lot of these previous highs that were in the upper 80s. And, I wouldn't put it past the hog market to maybe revisit the scene of the crime where we had broken out from several weeks ago and get back into the upper 80s to low 90s and get back to where, the indexes are trading. And so I think, to me, and again, the theme of the year in risk management, I think, is using puts, establishing floors. You can afford to give the market a little bit of room here with a put rather than just go ahead and, selling it. If you still feel that there's a big picture bullish narrative out there for inflation, but I think it's money well spent to have a floor under a lot of these markets, hogs included. Now, looking at the live cattle, you got a kind of a gnarly forecast here domestically, so there's going to be some stress put on livestock. I think that was part of the support under both the live and the feeder cattle today. We had a higher stock market, and I think that can provide some positive sentiment for the livestock. And then you look at the corn board, being weak, and that will usually help the feeder market. So I think you had a couple things helping our four-legged friends today, but it's another market where, again, I think it's very worthwhile having some puts under both live and feeder cattle. The charts look pretty good. There's no denying that. But again, that stuff can change very quickly.
Well, and I think as well in the cattle market, depending on what we see for cash activity this week, can we get a little higher? Can we continue to churn higher in feedlot country? We start to think about spring around the corner, summer grilling demand, hopefully working our way out of the pandemic. What is all that going to do for beef demand here domestically? I think that's something to watch as well, Brian.
Yeah, absolutely. We're going to see, very quickly back to spring. And I know I'm very much looking forward to getting in front of my grill a little bit more often. Not that I've stopped doing it, but generally not with the frequency that I typically would. So, if we can get these slaughter rates to get right back up there and see that come back to some aggressive levels, I think that should be supportive here in the big picture. But I think, your biggest challenge to the live cattle market is going to be some kind of a macroeconomic event that, takes that market a step backwards.
Well, Brian, a lot of great stuff today. And again, just feels like all this volatility we're watching closely. It just means be smart about your marketing plan is probably the best advice, and being disciplined. Any final thoughts you have for us here on this Tuesday before we run out of time?
Yeah, like you mentioned, I think this is part to be smart about your marketing plan. Know yourself. Part of my job as a broker is to know my client, and I can't know my client unless my client is honest with themselves and honest with me about what type of risk they're willing to take, or whether or not they want to be in marginable positions. Marginable positions sound nice until you're sending in margin money. So it's one of those things where if you just don't want to deal with it, then don't put yourself in marginable positions. But we're at extremely profitable levels right now on old crop corn. And I think it makes a lot of sense to figure out a plan on how to finish up your marketing year there. And, really, you got to figure out how you want to be positioned here looking into the rest of 2022 as we get into the field and plant that crop.
Well, Brian, if producers need some advice, they want to work with a broker such as yourself there on the agmarket.net team, I know it's very easy to get a hold of you guys, probably just by going to the website or giving you a call, can't they?
Yeah, you can go online, www.agmarket.net. We have a toll-free line, 844-4AGMARKET, so 844-424-6758. And if anybody wants to talk to me directly, 815-665-0463.
With that, Brian Splitt with agmarket.net. We appreciate the time. Thanks for joining us on this Tuesday, sir. Have a great week. We'll talk to you again soon.
Yep. Thanks, Jesse. Appreciate it.
Brian Splitt with agmarket.net. That's going to do it for our episode of Market Talk on this Tuesday, February 15th. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.